I'm Samantha Rowland, and this is Refi TV. Our guest today is Stuart Saft, a partner at Dewey LeBoeuf, and we're going to be talking about legislation that could have an impact on the residential and commercial real estate lending market. Thank you for being here, Stuart.
It's my pleasure.
Now, there is some legislation included in the Dodd-Frank Financial Services Reform Bill that address predatory lending. Could you tell me about that?
Yes, Title 14 of the Dodd-Frank bill is called the Mortgage Reform and Anti-Predatory Lending Act. And although the name indicates something that's profoundly important, because of the detail contained in the legislation, it probably would be better off called the Anti-Mortgage Reform Act, because the net effect of the legislation will no doubt be a reduced amount of residential mortgage lending and an adverse impact on securitization of those loans.
Right. How will it have an impact on securitization and lending?
Well, the legislation is a 230-page amendment to the 11-page Truth in Lending Act. And although everything contained in the legislation could have been contained in regulations issued by any one of several government agencies, instead a tremendous amount of detail was packed into this legislation. And unfortunately, there were no hearings on the legislation. Title 14 was added to the Dodd-Frank bill when it was under review in the House of Representatives and then enacted virtually unchanged by the House, the Senate, and signed by the President. The detail contained in the legislation will create a situation, or has created a situation, where there will not be very much flexibility, because instead of leaving it to the regulators to determine what the rules should be under the legislation, everything is packed into the legislation, which is the reason why it's an over 200-page addition to the Truth in Lending bill. Part of the problem with the legislation is that it requires lenders to be certain that the borrowers can repay the loan, and not only repay the loan, but also pay all of the other costs associated with owning a home. This will necessitate borrowers, lenders doing a significant amount of due diligence on their borrowers before making the loans, and if they don't, the borrowers have the ability to challenge the loan in court subsequently. The legislation also gives borrowers access to the federal district court system and also negates any statutes of limitations. So 20 years after a loan has been made, the borrower could raise as a defense to a foreclosure some aspect of the law that the original lender or servicer failed to comply with. Those complications will make it very difficult to pool mortgage loans together and securitize them. And although the securitization market is still rather moribund, coming out of all of the financial crises of the last 2 years, most of us expect that the securitization market will return, because until it does, real estate finance will be very difficult to do on a large-scale basis. This new legislation will have an adverse impact on the ability to securitize those loans.
And also, just based on what you were saying, it seems like there's not much incentive for a lender to actually make loans with this increased level of due diligence, as well as the liability that could happen, as you said, with no statute of limitations.
Well, certainly, if lenders have an option of where to make their loans, there are better opportunities for them in markets that are less constrained. And it is an unfortunate situation, because right now we're still trying to climb out of the housing crisis. Lenders aren't making as many loans because they're trying to rebuild their balance sheets. Fannie and Freddie, having been taken over by the government, are now being very conservative in making loans and underwriting loans. And this just adds an additional layer of concern for any of the lenders getting into or wanting to get into the mortgage lending business. And until mortgage lending increases significantly, the housing market will not improve from where it presently is. The newspapers for the last week or two, have been reporting that the problem is that the $8,000 tax credit expired, but in reality, the $8,000 tax credit didn't move the real estate or the housing market very much. What the housing market requires is credit, because real estate is such an illiquid investment.
And also, one thing that I'm curious about as well, with this level of detail and restriction, is this going to have a negative impact on a lender's ability to work out a loan should it go south during the term of the mortgage?
Well, I think that's absolutely true. That the borrowers, to a large extent, because of all of the additional protections given to them in this legislation, will have less of an inclination to work out loans with lenders, because they have the ability of going into the federal court system and raising as defenses any mistake the lender may have made in this process, very much more complicated process of making the loans. So there will be a disincentive for borrowers to negotiate changes in their loans, as well as an increased amount of litigation. One of the really strange parts of this legislation is that after several decades of trying to move away from litigation to alternative dispute resolution to resolve disputes, the legislation prohibits loan documents from requiring binding arbitration or other alternate dispute resolution methods of solving disputes, so that at the present, under this legislation, everything will wind up as a litigation, and unless the borrower, after the default occurs, agrees to an alternate dispute resolution method, but there's no incentive for the borrower to do so. They have a much better chance of succeeding litigating. The other problem is that the way the legislation is written, there's also an incentive for class action litigation against lending institutions if the plaintiff's lawyers can find that a particular lending institution misinterpreted one of the myriad of rules and regulations coming out of this legislation.
Wow, that seems like a pretty significant change from the current environment.
It certainly will make matters worse.
Another thing that occurs to me is that most banks lend on lower quality housing under the Community Reinvestment Act, but it seems like this legislation might actually be at odds with the CRA. Is that just my perception? Or
No,
is that
you're absolutely right. There are such detailed requirements for making loans that it's going to be hard for lending institutions to comply with both this legislation and the Community Reinvestment Act. And it's further complicated by the fact that that Fannie and Freddie, under the new requirements and under their new lending restrictions, are also not excited about taking CRA loans into portfolio, and that's going to make it very difficult. It's particularly difficult for the large money center banks that need these CRA credits in order to open multiple branches. So that's a particular problem in the legislation that we're going to still have to work through.
Now, we've talked some about the impact on the residential side, but I'm curious if there will be an impact on the commercial side as related to apartments and other multifamily housing.
Well, the entire real estate finance community is tied together, both residential and commercial, at so many different places that a reduced amount of lending in one has to have an effect on the other. For instance, a great deal of the multifamily housing in the past has been converted to cooperatives and condominiums. This legislation will have a direct impact on the ability to convert buildings, residential buildings, to cooperatives and condominiums. The other problem, of course, is packaging loans for securitization. The residential part of the market, to a large extent, provided a lot of the AAA ratings for the pools of loans, but that now is going to be problematic because of all of these additional requirements and making certain that the lenders have complied with everything. So it will affect the commercial market as well. Not as dramatically, of course, as the impact it'll have on the residential market.
Well, thank you, Stuart. This was a really good kind of overview of what's going on with the legislation from the Dodd-Frank bill and how it could affect the residential and commercial lending markets.
Well, thank you for having me. I
Yeah.
thoroughly enjoyed it.
Oh, thank you very much, and hopefully we could revisit this at some point soon.
That would be terrific.
And I'm Samantha Rowan, and this is Refi TV.